everyone, and welcome to the November edition of the Ag Economic Dialogue Sessions. We've got a great lineup of presentations and presenters here today. So without further ado, and to make sure that they have full time for their presentations, I'm going to turn it over to Triwit and Matt Dearson, and they can do a little more self-introduction if you would like at that point and take it away from there. So, Jewett, the floor is yours.
Thank you, Heather. So, good morning, everyone. I am Triwit. I am an assistant professor of economics at the Ness School. And today in our Ag Dialogue, I want to talk briefly about I guess everyone is already interested in the topic, macroeconomic conditions, interest rate path, and are we actually heading toward a economic recession? So let's go. So we're going to talk about interest rate. Can we understand interest rate kind of scientifically? What are the bedrock of, what are the determinants of interest rate, current interest rate, and recession risk, and how can we tell if there's a recession risk? And next slide would be, there we go. So over the COVID pandemic in 2020, the Federal Reserve cut interest rate to near 0%. And since then, they kept rate low at 0, but then starting from around September 2022, the Federal Reserve, we're in a rate hike cycle, meaning that the Federal Reserve raised interest rate from near 0 to 5.25%. As you can see, those ladder going up. And then we have been at a high interest rate for a while, at around 5.25 to 5.5. And now we have a rate, and the rate cut cycle already began. The Federal Reserve started to cut interest rate in September, 2-3 months ago, 50 basis points, and then they cut again in November, just a few weeks ago, actually, 25 basis point, and then this December, in a few weeks, they are deciding what to do with interest rate. Okay, but now we can firmly say that we are already in a kind of a rate cut cycle. Okay, what made them do that? And so the reason is that they cut interest rate because economy was struggling during the pandemic recession, and then the Federal Reserve have been fighting over high and rising inflation. So from supply chain bottlenecks, from many reasons related to the pandemic, the Federal Reserve have to raise interest rates. And by doing so, they raise cost of capital. So now for people who want to buy their homes, expand their investment project, borrow to expand their farms, and buy the tractor, buy the car, interest rate of everything go up. And that's their goal. They want to slow down the economy because inflation is too hot. And they did so successfully, and inflation rate has come down. But now they sort of think that inflation may be a bit closer to the target of 2%, and so now but then there's some problem now, which is unemployment that is picking up. Non-farm payroll employment's added at a bit lower than expected over the past few months, and so that's why it triggers the Federal Reserve to start cutting interest rate. Okay, so this is this is kind of where we are right now. Let me move to the next slide. So the Federal Reserve is playing a game of targeting the bull's eye. So they try to maintain, this is from the dual mandate, the so-called dual mandate, average 2% inflation over the long run, so-called price stability, and the maximum employment, meaning everyone who wants to have a job should be working, right? Full employment. And so they maintain the unemployment rate at about 3.5, 3.7%. So that's where we have in the graph. This is, I take it from the textbook that I teach money in banking course. Unemployment is at 3.5, inflation is at 2. They target the bullseye. And so if inflation is high, they raise rate. If the inflation is low, cut rate, and unemployment rate is high, they'll cut the rate so that the firms can, cost of capital is lower, they bring their laborers back to the market, and vice versa. Okay, so this is a game that they're playing. In terms of the data, what do we macroeconomists kind of pay attention to on a regular basis? So we have two sides of the table, inflation and output or employment, okay? And so inflation, we pay attention to CPI, Consumer Price Index, core CPI, meaning inflation, but excluding food and energy prices, because those are volatile component of the price. And then we have PCE, personal consumption expenditure. So the Federal Reserve favorite inflation measure is the PCE, personal consumption expenditure. They prefer that to the CPI for a few reasons, right? So CPI fix the basket across years, and so but they don't take into account how people switch products around, which is a bit unrealistic. And also, I think PCE is more inclusive of the goods that focus more on consumers rather than price of everything else. And so that's the Fed favorite measure of inflation, PCE. To 2.5, if I remember correctly, but now it has been stubborn though. Inflation is a bit stubborn. Right now we are hitting a little bit higher, or the most recent data point bring it a bit higher to 2.6 to 2.8, depending on the calculation. So inflation is sort of in control, but still quite a bit above their 2% target. Okay, both the PC and the CPI. The job search rate is okay. Labor market is sort of okay. House price growth is sort of in an okay mode as well in terms of on the inflation side. On the employment side, we have GDP. We pay attention to the GDP, industrial production, non-farm payroll. Make a little bit of actions in the economics and financial market, because it asks how many jobs are added in the non-farm sector of the economy. And they announce that on the first Friday of a month, every month, okay? And I can tell you that for the past few months, since August, the number of non-farm payroll employment has been quite kind of on abysmal side, meaning it's much lower than what everyone estimates. And so that, to me, this is the alarming trigger that triggered the Federal Reserve to start cutting interest rate that we saw, okay? Coupled with the jobless claims that are rising quickly, and unemployment rate also start to pick up from 3.7, but now we are at about 4.1. So 10% increase in unemployment. But for the number like unemployment, it's a bit of it might be just the problem to start to review itself, but it might be just a tip of the iceberg, because the way we think about employment is that it's a lacking indicator or backward looking indicator, meaning that once you see some problem, some issues show up, a lot more is coming, because the way employment contracts work is like per annual or 2-year, 3-year contract. Even if the firm want to lay people off right away, they can't do it right away because of the labor contract stickiness, or they can't cut the wages right away. And so the way they do it, they will make you work more, not paying or not raise the wage, and gradually lay people off. So that's what they do. And so I feel like if we start to see negative development on the unemployment or jobless claims on non-farm payroll, that's really not a good sign. A lot more is coming, okay? And so these are the news that we pay attention to. So to put in perspective, the red line is unemployment rate. It's at about 4.1, 4.2%, as I said. And I think the blue tabs are the non-farm payroll, has been kind of falling off as well. So that's what I just talked about. In terms of the inflation, this is a much more interesting object. In terms of the inflation, the market sort of thought that inflation was in control, at least as of like a few weeks ago in November. We are back to PC of 2.4. Sound like a reasonable, manageable. But if you pay closer attention to CPI, as I show here, CPI for all items, even core CPI, less food and energy, we are still talking about more closer to 3% inflation rate. It's actually core CPI right now. If you make a careful calculation, not just year on year, it's actually at 3.42% right now. And the CPI is 2.96 or meaning 3%. And so right now we have let's say we have 3% inflation and still and rising unemployment. Should the Fed be cutting interest rate or not? Let's think about it, right? But let's look at their dot plots. This is a dot plot. So what it is okay, FOMC, you know FOMC, right? They meet 8 times a year to decide on interest rate path. The Federal Reserve Governor, New York Fed presidents, and the president of the 4 other regional Feds, they come together, sit down, 12 of them, voted on interest rates, okay? And their opinions are represented by these dots, okay? And so there should be 12 dots, and the distribution simply show their difference in opinions, okay? And so I think the left column is the current interest rate path, 4.5 to 4.75% as of previous meeting, right? But then in the longer run, the rightmost column is the longest run Fed funds rate projection, which is stand at about 3%, even though with wide dispersion in opinions. So they try to target 3%, meaning that we are at 4.5 now. They look for 3% in the coming 3 years. We have 1.5% more to cut. So the Federal Reserve have room to cut according to this picture. Okay, and but we're not 4.5. In December, the Federal Reserve is gonna decide on at 18 December, they're gonna meet again the last time of the year to decide whether the interest rate whether they're gonna cut interest rate further from now. And the original plan is they was gonna cut, okay, down to 4.25% to 4.5%. Even though just as of yesterday afternoon, Jerome Powell made a speech, and he said that there's no rush for them to cut interest rate. And so, even though this is from the FedWatch tool, meaning that this is the probability of the Fed cutting rate according to something called Fed Funds Futures. Fed Funds Futures. This is the financial instrument for the rate that the federal funds rate is traded 3 months from now. So it's kind of forward looking, and kind of the market meaning a lot of Wall Street people deciding on making a bet in terms of what is the Fed funds rate going to be traded in the near future. Okay, so this is, I got this from FedWatch. The Fed Fund Futures trade in the Chicago Mercantile Exchange, CME. Okay, they handle the futures trading. And the market placed a 75% probability of a Fed cutting 25 basis points in December, and 25% that they will maintain. But this morning, I didn't have time to update the chart, but just this morning, that probability of 75 already cut to 50%. So now the market thinks that the Fed have only 50-50 chance of cutting rate to 25 basis point more, and 50% more likely that they will maintain the current interest rate. In my opinion, they will maintain. They won't cut the rate because they already start to see upward development in inflation, meaning that price growth are still on the rise. We haven't controlled inflation quite yet, and so there's no need to rush to cut interest rate. Okay, we have to keep cost of capital a bit high to still slow down investment. Unemployment rising, non-farm payrolls, negative development is there, but it's still sort of manageable. And so I can see that the Federal Reserve will decide to maintain rather than cut interest rate in coming December. Okay. Well, they might cut in January, but they are data dependent these days. They will have to see December data before they make a decision on January data. But in my opinion, if they don't do it carefully, they can create a very bad situation for the economy where inflation is high and rising out of control, and high unemployment as well, so-called stagflation, which happened in the 1970s. So the Federal Reserve, meaning that if they cut too fast, too soon, the economy can be stuck in a stagflation mode, which they want to avoid very much. That's not good. Okay, so in my view, they should really maintain interest rate, if not raising the rate. Okay. So this is from Fed Funds. This is dot plot. There might be changes in dot plot in the coming meeting as well to reflect the new inflation data that just came in recently. Are we heading toward a economic recession? So that's $1 million question. And one way that we take a look or make a guesstimate or academic prediction is we look at the so-called 10-year 3-month spread. This is the 10-year US Treasury yield. You take that minus yield on a 3-month US Treasury bond. And then you subtract them, 10-year minus 3 months, called spread. And if it's negative, historically, it implies that recession is coming with very high likelihood in the coming year from that point. So as you can see, this is 1989, 10-year 3-month is negative, recession coming in 1991, and 10-year 3-month dip to negative, 2001, recession come 2002. Indeed, global financial crisis 2008, the spread started dipping since 2006. And even COVID pandemic 2018, it predict recession. That's sort of weird, actually. I don't like that because COVID seemed to be more like a health-related recession rather than a recession that emerges from credit conditions, economic cycle, business cycle, monetary conditions. So that's sort of concerning, but it still predict recession. And as of right now, as you can see, the 10-year 3-month spread is deep in the red for a long time, or well over the past year, since 2023, the whole year 2024, we have been in the negative, even though there has been a little bit of a positive development because 10-year yields just rise a little bit from the presidential election. People sell off the bonds and move back into equities because people think that have a more risky attitude toward investing more in the risky assets, and so they sell the bond, buy into equities, and when you sell the bond, the 10-year Treasury yield gonna go up because less demand mean lower price mean higher yield, right? That's what we talk. That's supply and demand. That's why we see that spike recently. So, but are we heading toward a recession? This is $1 million question. If we still believe in the reliability of this 10-year 3-month spread, yes, recession should be really around the corner in 2025. In my opinion, recession has been dragged on. It's there on the table, but it has been dragged on for many reasons, and I believe that it makes sense because over the past years, a recession it's an election year, and so a lot of government money, fiscal money, were spent on the ground. We are only 4 years away from the COVID pandemic, and so the economy still has its resilience from that major pandemic, and so recession is dragged on, but we have the recession risk on the table in 2025, though. That's still on the radar. But in terms of the reliability of this indicator, meaning that whether 10-year 3-month spread continue to predict recession well, in my opinion, it's the power is a bit wane now because of the Federal Reserve QE programs. Since 2008, they conduct quantitative easings. And that quantitative easing, the one thing that they do is that they buy houses, buy mortgage-backed securities. In doing so, they lower the 10-year, they lower the long-term yield. The yield on a long-term bond is lower down a lot. And so, because of that, the power of the 10-year 3-month spread as a predictor of recession may be a bit wane now because it affects the 10-year yield directly, those QE programs. And so we have a stubborn inflation, 3%, acceptable employment conditions, likely mean that I think the Fed is already cutting rate too much and too soon. New government policies, geopolitical risks, trade conditions are likely to put upward pressure on inflation. Massive deportation can generate inflation. If there are a lot of war in the Middle East and the oil price increases, can create upward pressure on inflation, and many more policies that look like inflationary rather than otherwise. Recession risk is on the table as well in 2025. That's my conclusion for today. And if you have any question, please feel free to ask.
So we'll open that up to questions if anybody has one now. Otherwise, we will do questions at the end as well if you think of some as we go forward. So you can type those into the chat or unmute your microphone if you have a question. Otherwise, thanks a bunch, Triwit. We'll have you stop sharing and we'll get Matt Dearson up.
Dr. Dyson. Yep.
Thank you very much. So as you have questions, please feel free to type them in the chat as we go. Otherwise, write them down and we'll get those answered at the end of the session.
Heather, will you just confirm that you can see my title slide?
Confirming.
All right. Thank you very much. Good morning, folks. To sort of complement or dovetail into Triwit's general comments on the interest rates, I've got some observations and things I've been looking at or considering relative to the ag side or ag interest rates. And mainly it'll be more of a what are some of the effects of changes in interest rates? Where might you look to quantify those or see how those would ripple through either on an individual farm level or in terms of, say, a loan portfolio if you're coming at it from a lender perspective. So as Triwit mentioned, we've had the Fed funds target rate, that's the bottom blue line here, as that has increased and then in the last few weeks or months here has sort of come down slightly. What's happened to the interest rates paid by borrowers? So that would be the bank prime loan rate as one example of that. That moves or has moved consistently with the Fed funds target rate. This only goes back to 2010. That's just to sort of isolate the last two rate increases that we've seen and the impact on the bank prime rate. So before 2016, you can see that the bank prime rate was about 3% higher than the Fed funds rate, and those move together. And then in this most recent run up, we've seen that bank prime rate go from 3.25% up to about 8.5%. So in the last 2 years, you've seen a great increase in the cost of borrowed money. So if you're a farmer looking at that situation or an agribusiness looking at that situation, now all of a sudden your cost of funds has increased dramatically. So borrowed money is much more expensive than it was before. And also your overall weighted average cost of capital has increased. So you have to think about what is the profitability of different investments and how has that changed now that my discount rate, if you'd use that weighted average cost of capital as the discount rate, what's happened to my discount rate? That means that some of those investments that were looking good before haven't been looking as good now. And that's been the ripple effect of that. Big picture, we had the 2022 Census of Agriculture released earlier this year. And just as take a snapshot of that, I looked at interest expense. And for 2022, the year that the census covered, the interest expense by farmers and ranchers was $13.4 billion. That was down from the 2017. And then if we look at a breakout of the 1.9 million farms across the U.S. who reported expenses, only 32% had interest expense during 2022. So there are farms without any debt and without any borrowed money at all, but they would be more likely to be smaller farms and more likely to be already retired farms. So they're still farming, but they're not farming, and they're caught up in the census. So it's a little bit what's going on with that. In terms of how many how many lenders farmers have, we've got an earlier survey here from 2017. About 70% of farms had no debt whatsoever. That's that retirement farm group for the most part. We look at those who do borrow money, and you have about a 2/3, 1/3 split. 2/3 of the farmers that borrow from one lender or have one lender. So that might be a commercial bank they work with or a farm credit association that they're working with. But then a third of those that do borrow money have more than one lender. So you might be borrowing from a credit union and a farm or a commercial bank and a farm credit system and an insurance company and such. So multiple lenders can also be common. For large farms, that same larger commercial farms, you end up with that same relationship. Much higher proportion of those borrow money to begin with, and then almost an even split between having one or multiple lenders. And just big picture, what's happening with the debt side of the ledger. This is for all farms and ranches across the United States. This is the last comprehensive set of data available. So this is from 2023. It just shows that you've got about a 40-40 share for non-real estate. This would be mainly operating and machinery loans. About a 40% share by commercial banks and a 40% share by the farm credit system or farm credit associations with that share. And then you can see individuals and others provide about 20% of the non-real estate debt. So that's at $174 billion in 23. Real estate debt was a larger dollar amount, $345 billion. So this is primarily land loans. Farm credit, and farm credit doesn't show up here. Big chunk of the pie down there is the farm credit system with almost a 50% share of real estate. And you can see the number 2 is commercial banks with about a 32% share. And then life insurance coming in on real estate with a 6% share. In 2024, the Economic Research Service back in August came out with or September rather, came out with an updated set of estimates for 2024. Non-real estate debt climbs to $181 billion and real estate debt climbs to $360 billion. And they report interest expense of $30.3 billion. So interest rates as measured by or estimated by the ERS is a different measure than the census. So that interest rate, even though it's a 2 years later here, that hasn't been anywhere near that $13 billion that was reported in the census. So there's some discrepancy between how census is measuring things and how the Economic Research Service is estimating things. For the most part, though, even with these higher absolute debt levels, the interest expense level has not been increasing dramatically. And the sector level or in the aggregate, the debt to asset ratio remains very strong. So land values have increased. So if you look at the sector, there's strength yet in terms of the debt to asset ratio. The other observation thought I'd share was that a lot of the debt is sticky. So I've been asking the various lenders that have come to campus, both to visit with our students and then at career fairs and out around the state. The debt we're observing, or sort of the consensus is, you don't forget, debt is sticky. So land is held for a long period of time, and the percent of new land loans in a given year is fairly small. The same with machinery, that's held for several years. And that means that we're not yet observing the higher interest rates when you look at some of the aggregate numbers. And the same goes with operating lines, lines of credit. I asked around the time of the bigger rate cut, what's been happening with operating lines and the interest rate with that. And the consensus was, well, we're really not at the time of year. We've got a lot of renewals and such, so we're not seeing a ton of rate changes for the existing operating line. So some of that higher rates trends have yet to be observed because of that. Wanted to look too at the general or overall cost of funding. So I'm coming at this from a couple of different angles. First, we've got to look here at the commercial banks across the United States. This is their quarterly cost of funding earning assets. So this is what it costs a bank to have money in the bank to lend. You can see that this goes back to right after or around the time of the 2009, 2010 as a starting period. And this is annualized data for whatever reason. It's just how the FDIC reports this, the Federal Deposit Insurance Corporation. The cost of funds earning assets, you can see bottomed out at very close to less than 0.25% in late 2021. That's why your interest rates on savings accounts, checking accounts was super low for a stretch there. And as the Fed has increased short-run interest rates, that has resulted in a higher cost of funds for commercial banks, and they're paying higher interest on deposits and such at this time. And you can see the dramatic increase from less than 0.5% up to about 2.25% to 2.5% at this time. Now, coupled with that is the yield on earning assets, or what a bank receives across money lent and other assets they would hold, securities and such. That was down under 3% at that same late 22 or early 22 timeframe, and that has increased up to about 5.5% to 6% at this time. So that means that as a borrower, you're seeing higher interest charges on borrowed funds. It's not the only series. We've also got a rather interesting or nice series from the Farm Credit Funding Corporation. They have a nice series of funding cost indices that goes back to the early 2000s, but here too, I've just isolated from 2010 up until current, and this is a monthly index. So there's a variety of indexes going on here. This is the Farm Credit System's cost to borrow money at the Farm Credit System level by farm credit banks. Those banks lend the money to the associations. Associations in turn lend that money out to farmers and ranchers. So this is analogous or similar to the bank's cost, the commercial bank's cost of funding earning assets. So but we've got the overnight rate on the bottom. I would follow very close to what the Federal Reserve Fed funds rates and such would be. Then we've got the 10-year cost index going through there. And finally, you've got in yellow, you've got the 30-year. So the 30-year bond as issued by the Farm Credit Funding Corp. What rate did they have to pay to borrow money? And this is over the last, say, 15 years here. So as the Fed increased interest rates the last two times, so in 16, 17, and then just recently, you can see the overnight rates go up. Now, the 10-year analogous again to the 10-year treasury, the 10-year cost of funds, the 30-year cost of funds, they don't respond always or in lockstep fashion. with changes in the Fed funds rate. So especially that 30-year, I would just say from 2010 up until late 2022, that index declined sort of consistently, or year over year, you had steady decreases in that. That's probably, in my thinking, it would be an indication that all long run returns had declined, and that would have been correspond with the lower cap rate you'd see on land values. So now the 30-year rate has increased as well. All different levels of costs to source funds to lend have increased from maybe the midpoint there would have been about 1.5% in the 21 era. And now it's all sources for all different durations or timeframes, much closer to 5%, 4.5%, 5% here recently. So the higher 30-year rate probably would put some upward pressure on the cap rate, which would put some downward pressure on land values. And then just the overall cost of funds here would have gone up over the last couple of years, and fairly dramatically, depending on, or regardless of the time horizon you're looking to source funds to lend out. Also have some interest rates from the 9th Federal Reserve District. So these are federal fund member banks. These numbers were updated, reported out briefly this morning. So I'm doing a little bit of a guesstimate as far as the third quarter number here, but for the most part, they thought interest rates were down for land and fixed loans by 1.1 to 0.2% in the latest quarter. So we've got some stability with operating loans still hovering 8.75%, and land loans down around 8% on average across the 9th district. So the Dakotas, Montana, Minnesota, and sort of the UP area of Wisconsin and Michigan. So across the upper Midwest, the Minneapolis district. So that's what's happening with rates. And I bring this up to show a couple things. One is just the overall dramatic increase in rates from a low level of real close to 4% to 8%. So that's a 4% increase on land loans, and about the same level of increase on operating loans or lines of credit over this recent 2-year period or recent 2-year stretch. So what would those higher rates mean, or how would that translate into changes at the operation level, at the farmer ranch level? And for that, we'll look at a couple of things. Just put together a little bit of aggregate data from the Center for Farm and Ranch Management that's run out of the Mitchell Technical Institute down in Mitchell. And this is it's the farmers they work with over the last 5 years here. So it's from their annual reports from 2019 through 2023, just to give you a big picture overview of what's happening at the local level in terms of how much debt and what's happening with interest expense. So average debt you can see from 2019 through 2023, that's the left-hand axis there. Farmers had started with around $1.4 million on average for a farm, and now it's increased up to about $1.8 million over the last few years. So debt has gone up. Why? In part because land values increased. So if you're borrowing a similar amount of money to, or you're borrowing money to purchase a similar amount of land, you might be adding debt from that alone. So that's pushed the average debt higher. At the same time, interest expense is there. So interest expense here by these measures is cash interest expense. So the actual interest bills paid, but also the change in accrued interest. And this isn't the same set of farmers every year. So we've got a little bit of a it's just the nature of this sample. So it's not like this is the same 10 farmers measured where we have the beginning and ending expense levels. So a little bit of different samples going on each year here as well. But But end of the day, what we have here is interest expense because interest rates were very low in an absolute relative sense. In 2022, interest expense was very low. In 2023, or as recently as 2023, interest expense much higher, going from about 60 to about 75,000 from 22 to 23. So what? Well, the reason to look at these components is now we're moving into a situation where you're really starting to see all of those interest rate increases that have happened to lines of credit and machinery and land. You're starting to see some of the different real effects of, oh, we're finally seeing 2 years of higher interest rates come through on balance sheets and such. So how do you make sense of what's happening with both debt and the interest expense? One measure that had fallen out of favor that might be time to revisit, to think about both for your own operation and for a pool of customers, would be the cost of farm debt. So the cost of farm debt is analogous to an interest rate you see on your debt, because it's the interest expense divided by average debt or average liabilities. So here we've got cost of farm debt over the last 5 years for the center's data, was at 5.5 in 2022, fell down to as low as 3.5, and in 23 had increased. For 2024, with higher debt levels likely or expected and much higher interest expense levels, we could see the effective cost of debt continue to, or certainly increase for 24, and can very well increase in 25, just on the momentum of higher rates on loans moving through the averages that we get here. So that'll be one measure or thing to follow as a proxy for stress on the farm sector, but then also as that cost of farm debt goes up, that should enter into the calculations for a producer, for farmers and ranchers when they're doing their capital budgeting decisions and evaluations as well. So we've got the cost of farm debt. The other measures that might make some sense to consider or look at with this interest rate environment would be some interest and debt coverage ratios. For the most part, farmers and ranchers and farm lenders have been using term debt coverage ratios, but stepping back and looking big picture at some of the interest and overall or total debt coverage ratios might make a little sense in this environment. So interest coverage ratio and all debt coverage ratios generally would use income from operations, add in interest expense observed, and then add in depreciation and take out owner withdrawals for paid labor and taxes and any net contribution as far as contributed or other withdrawals. So that really says, hey, a farm or ranch has this much profit that could be used to cover principal and interest payments on debt. The interest coverage ratio would only include the interest expense in the denominator. So that would be times interest earned. How many times or how much income is there to pay a given level of interest expense? And then the total debt coverage ratio, which is it is an endorsed measure by the Farm Financial Standards Council, and in their guidelines, they would say, what if you took that same numerator, income plus interest expense plus depreciation, less those withdrawals, and then divide that by the combined interest expense and scheduled principal payments. So that would be the total debt coverage, or the debt coverage ratio, the ratio of your ability and uses for those repayment levels. They're not the most common, or they're common across other sectors, but they're not as common, even though they are. The debt coverage ratio is the endorsed one. Again, it's just a little bit different. And when you use the term debt coverage ratios, which some people and some associations and stuff still use, that takes interest expense out of the picture a little bit differently, or treats that differently, because you're only trying to cover term debt principal payments with some of those other measures. So what's happened to interest coverage ratio? What's happened to debt coverage ratios? They were tight in 2019. If that ratio is not above 1 for interest, then the operation's in a really tough situation. The total debt coverage ratio, if that's not above 1, that's also that's a bad situation as well. We can see here, for the most part, with good yields and prices, 20 and 21 and 22, those coverage ratios were strong positions. So plenty of ability to pay interest and principal payments. 23 started to tighten up a little bit, and then one would expect for 2024 that this would be much tighter in terms of much lower incomes, profits, and higher interest expense, that these ratios will be under pressure. And that would be the case going forward into 25, 26 and onward as well. So those two ratios are other ones to consider that might not be as common or as commonly tracked, measured, recorded, but interest coverage and total debt coverage ratios might have a place in this environment. As Triwit had shared, I grabbed a more current version of the Fed funds projection. So here was a 60-40 split. This was yesterday afternoon. So yeah, the consensus for a rate cut immediately in December has kind of waned a little bit. The other thing that the CME does is they put out the dot plot, and they overlay that with their little red dots there that show the Fed funds futures price. So 2024, it's kind of buried here. In 25, the red dot is buried right here at about 3.75, 3.8% would be where that red dot is buried. And then in 26 and 7, relative to the last set of dot plots put out by the Fed back in September, the futures prices for the Fed funds rates suggest that interest rates aren't going to decline as rapidly as the Fed's projection. So it doesn't mean the Fed's projections changed. The Fed's projections stopped in September, and the futures market has continued on, and the futures are saying that we don't think that those set of dot plots are as representative right now, or trade could also be wrong because these projections go out to 2027. But it does give us some idea of where interest rates might be headed or how much they might fluctuate. And one last application of this is in the margin protection endorsement. I've looked at this a little bit here this fall, just trying to make sense of could a farmer hedge interest rate risk? They would use this fancy combination of things, combining fertilizer prices and potash and diesel together, and some fixed costs, for example, and throw that together. And here's what it looked like in 2024 for corn. Started the season, the 2024 crop year, with expected margin costs components of about $370 an acre. And so that 370 would be multiplied by an interest rate to say, what if you had operating loan interest on that $370 for only 6 months of time? And how does that play out by the end? Well, after the 24 crop year has ended now, you've got the price changes on a per acre basis, and urea prices actually fell. DAP prices increased ever so slightly, diesel prices fell, and interest rates actually declined slightly. So the net effect using the margin protection calculations was a per acre interest charge decrease of 44 cents an acre. So if you just looked at last year, you'd say, well, there wasn't a lot of short-term interest rate risk that one would have tried to hedge or lay off using the product. But the steps are what was interesting to me more so than how things played out just in 2024. So one last little chart to take a look at was the performance or how things played out in terms of the Fed funds interest rate, because that's what the margin protection endorsement product was tied to. So you have to back up to September of 2023. So about over a year ago now. And when that product was sold or that endorsement was calculated out, you were looking at the Fed funds rate for November of 2024, which just is in the process of ending. And at the time, you'd have been looking at the Fed funds rate or a Fed funds futures level of around 95.4, 95.5. That meant that the expectation was that the interest rates at this time, a full year later, would be about 4.5%. And then it increased from when the insurance endorsement was originally set up and sold. The Fed funds rate increased to about 96, which would have implied a Fed funds rate of 4%. And then the futures declined until this period. That's what the bar is showing here. So that Fed funds rate got down to 94, say 95 there. That implied interest rates would be closer to 5%, and then it leveled back off. So it ended about where it started. So this highlights a couple things. One, it conceptually it's possible to think about or have a way to hedge interest rates. And two, you have to think about not just where rates are, but where they're likely to go and how much of that's already built into the market. So when that margin protection setup was done at the beginning or about 2 months ago here, it was looking at November 2025 Fed funds already suggesting a 3% Fed funds rate. And that has since done this, gone down, saying, oh, all that expectation of a 3% Fed funds rate is now much closer to a 4% Fed funds rate. So it's a proxy or something to monitor, try to make sense. But for the most part, if you're looking at hedging interest rates, you probably want some of the optionality involved in a call option against higher rates, which would be, depending on the product you're using, or might be a put option on an interest instrument. That's the kind of product and thought you'd want to look at. And they're not very commonly available or not readily available at this time. So that's what I had for today. Here's my contact information. And if there's questions, I would take them and or share the floor with Triwit.
Okay, well, thank you, Matt and Triwit.